Hey y'all, welcome to my YouTube channel. My name's Harry Knapp. Pretty much I saw this gap in this YouTube space where there wasn't a whole lot of content that I saw that was actually producing value. So what I wanted to do was create something, but not just anything, something that every time you watch it, you sign off and you think, I learned something new. And whether you like learning new things or not, I think that putting some time in with my YouTube channel might actually open your mind and put a little bit of light in this dark year that we've been experiencing, kind of open your mind to some very beneficial things and provide a lot of value to anyone that might tune in and watch. So that's kind of what I want to do, and I really just kind of want to open people's minds and show them some new things that aren't really talked about in school or in class or at the dinner table with your parents. I mean, what I really want to do is just open people's mind up to new ideas and new incomes and new strategies and new thought processes that really rewire the way that you think and help you to advance yourself and improve yourself in new ways. Because personally, I'm kind of like a self-improvement junkie, so I constantly find new ways to try to change my mind or add a little bit of struggle to my day, just so that way I can know what it's like to face challenges on a day-to-day basis, and it makes me a stronger person. But aside from that, I also try to train my mind, because I feel like your mind is your most valuable muscle. It powers your entire body. Everything from your arms to your legs to your eyes blinking and you don't even realize it. So I like to work this muscle out. I know a lot of people don't, but what I'm trying to do is on my channel, I don't want you to have to work real hard. I'm trying to break things down simple so that way you can understand it and you get the value out of it without getting all this extra stuff that you don't always need to hear. So hopefully, if it's something that you want to explore more, most of my videos will probably be like a brief overview, but if you'd like me to go into deeper detail, please drop in the comment section below and I'd appreciate it. And if you like what you see, please share it to everyone you know. Please like it and comment on it, subscribe. I'd appreciate it. Hopefully we'll bring a lot of value to the table. So today what I really want to talk about is going to be today in the stock market. Basically, if you don't know, the stock market is pretty much a place where fractional portions of a company can be traded from one person to another person on the secondary market, they call it. The first part of the market is considered the primary market. It's the place where businesses like a major issuer like JP Morgan Chase or some underwriting company matches up with a company like Google, for example, before they were Google, when they're just in a startup phase and they're like, yeah, we'll take you public. You might have heard of the term IPO. It stands for initial public offering. It happens in the primary market. So that's where the businesses get together and issue shares for the first time to the people. But today, in the majority of the time, we're going to be talking about the secondary market, which is where shares are traded between investors, people that want to put their money into something that could grow their money more than a bank account could. Because if we're going to be real here, the bank account, it's totally robbing you. You're looking, most banks pay maybe a 0.05% interest rate on a savings account or a checking. So if we're looking at that, that would look something like this. 0.05% would be right around that in decimal form. So we're looking for something that might be able to provide a lot of growth. That's the whole goal in the stock market. We want to take our money and add a little bit of risk to the equation, because with more risk, it produces more return. That's kind of the idea behind all investing, whether you're buying real estate or you're buying stocks or you're putting it in the bank. See, the bank is able to pay you this. They're able to rip you off because what they're doing is they're giving you this word right here. Safety. That is what you're getting for this 0.05%. But what people don't understand is the stock market over time, if you look at it, the chart is pretty much, it looks almost straight up over time. Yeah, there's waves that go throughout the chart, but if you were to invest money in pretty much any time in the past, it will have grown. Yeah, there might have been some bumps in the road, but that's why people like Warren Buffett have the buy and hold strategy, because you weather all those bumps and then it comes out being smooth, like a rock that's traveled a long distance through all sorts of different terrain. It might start out large and rigid and then it becomes small, smooth, and very spherical and curvy. Because when you weather those bumps in the road, they eventually get smoothed out. And that's kind of something that we're dealing with right now in the stock market. We'll get into that in more detail in a minute. I'm going to finish this point. But so the stock market on average produces a return of roughly 8% a year. So that's not always the case, but it's historically the average return. So what that would look like in decimal form would be this. 8% would be 0.08. So you're looking at about basically 0.08 divided by 0.005. That would yield you a return of 160 times more than what the bank would give you. And that kind of just, that should really freak you out. 160 times more money than what your bank is providing you for safety. But you know what they're doing with your money? They're going and they're doing this. They're investing it in things. They're buying houses. They're giving people loans. So they take as much money as they can for safety, and then they give out hundreds of thousands of dollars so people can go buy houses with it. That should spark a thought in your mind like, hey, why don't I do something like that with my money? Why don't I take my money and lend it to someone so I can make the kind of money that the bank's making? Or why don't I take my money and invest it in something that could give me the kind of return that the bank's doing with my money anyway? They're seeing all the benefit, and I'm seeing this word safety. And safety is really a confusing term because of something called inflation. And if you're not familiar with the term inflation, basically what inflation is it's the constant devaluing of your money. So on average, the historical decline of your money from inflation is 2%. So in decimal form, we'd be looking at something like this, 0.02. So for you to actually have your money making any money at all, you need to be trying to score above a 0.02 or a 2% return. If you're investing in a bank account, you're not even coming close to making that happen. I mean, you're making this look nearly impossible. I mean, you are not even coming close to hitting inflation. If you did 0.02 minus 0.0005, I mean, come on, you're looking at like 0.01995 as a return. I mean, that's pretty pathetic. Negative. You're minus this. You're losing money in the bank. Not only are they taking your money and making it more money for them, but you are missing out on this opportunity to the point to where you are also losing money with your money in a bank account, which in my opinion, that's a no-go. That's not what you want. You need to be thinking smart. You need to be on your toes. You need to be like, all right, if I don't know what to do with my money, I'm going to figure it out. And that's another reason that I want my channel to be here, because that's one thing that I'm trying to help people learn is what they can do with their money so they're not getting ripped off by the bank, or they're not stuffing it in a mattress and it's not buying the same that it used to buy. Okay, so coming back to this thought, like what does that mean that it's not buying the same that it used to buy? Okay, so that's where we're going to focus on this inflation rate. So basically, we're going to dramatize this whole equation. We're going to say that inflation has gone up 50% this year. I know that's outrageous. There's honestly no telling of what's going to happen with these 0% interest rates and all the money that the Fed's printing. I mean, we printed $3 trillion this year. It's a large percent of added money to the economy. And as it seems great that when people get a check, they're like, oh, that's awesome. We got free money, but it's not really free, because what it does is it adds more money to the system. And once that money starts getting spent, there's more money in there. So things become more expensive because it's a supply and demand equation. There's more supply, but the same demand for the same goods. So let's quantify this to make it a little bit easier to understand. We're going to say that inflation is 50%, which is completely outrageous, but it's going to make the numbers easier. So say you want to buy a house for $100,000, right? $100,000 for the home. That's what you need today to buy the house. But so say money goes up or goes down in value 50%. So you're going to need an extra 50% of 100,000, which is 50,000. So that house is now going to cost you an extra $50,000. So now you need $150,000 to buy the same house that you could have bought before for $100,000, because the demand is still the same. The house is still the same house, but the money, the supply has increased. So with more money means things become more expensive because it's less competitive to get money. It's easier to obtain. You've gotten free checks. You've got easier loans. They've printed out money. So it makes it's more available. So the supply of money's higher. It makes it easier to get, theoretically. So what that means is it causes that value of assets to go up, which is what we're going to kind of talk about in the markets today when I do my summary of like what all is going on in the market today on Thursday, November the 5th, because it's been a crazy week. It's coming up later in this video, but first I want to kind of lay the groundwork for what I'm talking about. So 150 grand to buy the same house, that means you've got to be either working or you've got to be investing, because if you still had $100,000 cash, you didn't put it anywhere, you put it in the bank earning 0.05% interest. I mean, I can't even wrap my head around that number. It's so low. If you're earning that on your $100,000 and you got a 50% inflation, there's no way that you're going to be able to afford this $150,000 house. But the good news is that you can put it in the stock market. The stock market is something that goes up as the value of assets increase due to inflation. So on the same note, if you had a stock that was worth $100 and then inflation is 50%, the value of the stock has went up 50%, now it's worth $150. So if you put $100 into that stock before the inflation hit, you now have $150 where you only had $100 before, and you didn't lift nothing but a finger to press buy on TD Ameritrade or Fidelity or something. So the same goes for this house here. If you had $100,000 in this home when it was worth $100,000, your home is now worth $150,000. So that is why some of these things really benefit the rich. You know, like you're thinking, oh, I got a $1,200 stimulus check. That's great. That's awesome. But it's really not, because if you don't invest it properly, you're looking at all these statistics like, oh, the rich keep getting richer. It's because they're doing this with their money. They see this inflation coming. They hear about these stimulus checks and they know that assets are on the rise because of all this extra money in the economy. So they dump money in assets. So that way, whenever the assets go up, so does their wealth. If you dumped your money in this house, your $100,000 investment's now 150 grand. You made a great choice, because if you left it in the bank or you left it under your mattress, your money just went down 50%. Your 100,000 could no longer buy you the same things it could before. So that's what I meant when I was saying that because of inflation you can't buy the same things. It's because with more money available to everyone, there's more supply. Prices go up. So if you still have the same amount of money, you can afford these things that are now higher value. Like this house that's now $150,000. You can't afford that anymore. But you could sell it for $150,000, get your money out of it. Now you have 150 grand instead of 100 grand. So this is kind of where investing really becomes important. So from there, I kind of want to lead into my discussion about today in the stock market and why all this really matters. As you can see, some of these things are really important to what's going on around us. And in 2020, I think that some of these things could really help brighten up your day, because I know that we're dealing with a lot in the world around us. So hopefully we can get you some value. So what I want to do is kind of tie this concept of asset inflation into what happened in the market today. So one thing that I want to look at and point out is the stock ticker GLD. Basically, if you can't tell, it kind of looks like gold. GLD is an ETF, which means it can be traded throughout the day, but it's a fund that follows the value of something. In this case, this fund GLD is going to be following the value of gold. So pretty much gold is considered one of the safest assets because it's something that if we had an all-out apocalypse, which hopefully it does not happen, but if it does, it's something that I could bring 5 gold chips and get a loaf of bread and some eggs or something. Like, gold is an asset because we've always seen value with it, and it used to be the basis of our currency, but now that our currency is a fiat currency, not tied to gold anymore, fiat meaning fake because we just print money, as I was previously discussing. But now gold has this value. It's like something that we still kind of promote a dollar figure to, like what gold is worth. And this ETF, publicly traded on the stock market that you can put your money into, is rocketing right now because of asset inflation. It's considered one of the safest investments because it's always going to be there. It's always going to have value. So right now, GLD went up, I believe it was 2.3% today. GLD, gold, 2.3%. If you put $100 in gold yesterday, you would have made $2.30. I know it doesn't seem like a lot, but for something that's so secure, you have to keep in mind that it's doing way better than what your bank account would pay you. So you're getting the security with this investment, and right now it's rallying. But the reason for that is because today, and the last couple of days actually, we've seen major drops in the US dollar. If you compare it to just about any other currency, US dollar to the euro, US dollar to the Japanese yen, the chart looks something like this. I mean, it's weak. It's not doing well. And because that's mostly because with all the reopenings and people going out and spending money to buy houses and do different things, they're currently using all this money that the US government and the Fed has invested in the people by printing all this money. By keeping us alive, they're currently devaluing the dollar majorly. So basically, it's doing this, which really is not very good, but it's understandable with all the money that the Fed has printed and all the money that the government's given out to everyone, that it's driving the value of the dollar down as the supply goes up, as we were talking about earlier. But what that's doing is it's causing massive increases in other assets like gold, which is up 2.3% today, which, think about it, relative to your bank account that's paying you 0.05% a year, this went up 2.3% today. And it's incredibly safe. Gold's considered one of the safest assets. This is the US dollar, and this is gold. Gold's doing this. And then this is other stocks. Google, Apple, they're all doing this right now. They're all hitting the moon. The moon's up here. It's like they're all reaching for the moon. Like, they're all skyrocketing, and it's all because the US dollar is going down and inflation is rising up. It's causing large problems for people that have low income because their money isn't buying the same. They need to be searching for jobs to either increase their wages or something because their money isn't going to do them what it used to do them. And that is one of the main reasons for the wealth gap in America, is because people don't understand, even if it's hard to do, you really need to put a little portion of your paycheck into something so that way you're getting some growth somewhere. Because if it's cash or you're just spending all your cash and you're like, I can't figure out another way to like pay my bills, like you've got to do something with that money or find a new way to make some money or work a little bit harder to take some extra money and put it in these stocks. So that way you're not part of this chart. That way you're part of these charts that are going up over time. So not only is asset inflation a main driver for some of the reasons the stock market's going up and some of these other assets are going up, but relating to the stock market in particular, I want to highlight a couple of other reasons why they're increasing so dramatically. For example, the Dow Jones, crazy enough, has went up. It peaked out above 600 points today, but it closed around $542 increase. Not only that, but stocks have increased 4 days in a row now. And SPY, which SPY is a really important ETF to pay attention to. It's the SPY. Basically, it's the summary and the affordable way to purchase the best 500 companies that America has to offer on our stock exchange. So SPY has rallied over 1% 4 days in a row, which is kind of incredible. But a couple ways to recognize if it's going to continue its rally is to, one, look at the US dollar and see how it's performing. And as we saw, hasn't been doing so good lately. If you look at the charts, I mean, SPY almost looks like it's doing the exact opposite of the US dollar. And that there's a reason for that. It's asset inflation, like I was just talking about earlier. So one of the ways you can know what SPY is going to do is by this term called volume. And what volume is, it's the number of shares, which are basically just shares of stock, pieces of ownership. Number of shares traded in a day. Number of shares traded in a day. Sorry, I kind of scribbled that, but basically, if the market goes way up and there's a high number of shares traded, that means the stock market really likes what the price move was. So the price move was up, there's a lot of volume. That means, hey, we traded a lot of shares and it rose this much. That means there was a lot of good sentiment around that stock. There's something called volume divergence though, which is kind of something that raises red flags if you're investing in a stock. If volume goes up and the stock price goes down, that means investors really like the price move, which means they like that it went down. If volume goes up and the price goes up, that means, let's see, volume, price, just to make it easy. That means that investors really like the market moving up. That's a smiley face. They like that. They like the move up. Then we'll put a smiley face here too, because that means investors really like the market going down. So now we're going to look at the opposite. So we're going to see what investors like when there's divergence between these. So if volume goes down, and the price goes up, that means there's divergence. That means investors are either frowny face, they didn't like that move, or investors are slanted face, like they don't really know what to do. I mean, it's not a clear indication that the price is going to keep rising. I think the best way to probably look at it is like, if volume is a gun, say a strong volume would be like a shotgun. You know that when you shoot that gun at that brick wall, that it's going to probably shoot through the brick wall or knock off a whole bunch of mortar. However, if that gun is a BB gun, it doesn't have the same amount of force. So that's not going to go through the brick, or it's not going to knock off a whole bunch of mortar. It's just going to bounce right off the brick wall because it doesn't have that same force behind it. Hopefully that was a good example, but it kind of illustrates what exactly volume does and how it drives the pressure behind the moving market. It's a very important metric, and it's one of the reasons why the stock market's rallying this week, is because a lot of stocks like Google, Amazon, Apple, Facebook, SPY, one of the most important ones, are seeing major volume behind the stock. Just to illustrate a little bit further, if we have low volume and low price, that means it's either a happy face because it could reverse into an upward trend because the price fell, so they didn't like it because of low volume, so it could be going up, or they could be slanty face because they don't really understand. There's divergence, so it creates a level of uncertainty when there's not enough force to continue that price drop. But that's kind of up to you and your technical analysis, which we'll get into that further about technical analysis. But for now, just know that these are very important metrics. You can go back and look at the other ones I drew before, but they're very important to decide the direction of the market over the coming days to weeks. So the next thing I really want to talk about is I want to kind of document what I've seen so far with this election. This is my first time trading an election because I didn't start trading until slightly after the election of 2016. So I really kind of want to highlight like what I saw happen here. So one of the things that I really noticed was in the weeks coming to the election, there was all this building uncertainty. And one way that you can track uncertainty in a market is by this ticker symbol called VIX. You can type this in on you can type it in on Google, and VIX will tell you the amount of volatility, which volatility goes up. Volatility basically is constant changing in prices. Like if it's changing a whole bunch, then there's going to be more volatility. But if it's kind of remaining flat, there's going to be low volatility. But in periods of uncertainty, where a lot of things are unknown, like elections, volatility is going to go up. It's going to have a chart that looks like this. So what we were seeing is a lot of volatility along with a lot of uncertainty, which was causing stocks to drop in price very quickly. And when volatility goes up, it raises the value of options contracts, stock options contracts. So that makes premiums very expensive. So if you're trying to make money with stock options, which is a very good way to make money, I'll go into more detail about that in future videos, but it causes the premium to go up, which means you have to have more money to buy in. And there's more likelihood that your value could fall rather than increase. However, what I noticed was after the election day, Tuesday, November the 3rd, we saw volatility drop dramatically. The VIX chart started doing this. It did the exact opposite because news came out. Whenever there's a lot of build up to a big event, volatility goes way up because of uncertainty. But whenever there's the news has come out from that big event that everyone was uncertain about, volatility begins to drop again. Contracts, if you're buying stock options, they get really cheap. The premiums are cheap, so you can buy in for low cost of money, and then they build back up as more volatility happens. So one of the things that we're seeing is now that the election has happened, this is the crazy thing to me, is we haven't had a result yet. So I don't know why we're seeing these major drops in volatility. If today's Thursday, we don't even have a result yet. That's kind of odd, but we're seeing these volatility drops anyway. I think it's because people have already kind of predicted the outcome, which could be fortunate or unfortunate depending upon your views. But in this case, it's driving stocks to go up because volatility is coming down and investors have all this confidence again, which I don't understand, like I said, because we don't have a result yet. But so it's causing the SPY. SPY does the exact opposite of the VIX. So if the VIX is up, the SPY is down, which we saw with election upcoming. Election coming. And then the SPY has now started rocketing now that we have a result as of Tuesday. It's been flying up, or not have a result, but I guess have a relative idea, and the news has kind of come out, and so is the polling. I mean, we had a poor week or two leading up to the elections, but now everything is taking off for the moon. So now we're looking at SPY is rocketing now that the election day has happened. So we're looking at post-election day, and we are rallying right now with high volume. Assets are going up in value because of the dollar falling. It's like the perfect storm. But these are the things that people don't tell you, and it's all being eliminated and left out of the news because there's an election day going on, and everyone that understands this stuff is sitting back on their couches with their feet kicked up and their laptops in their lap, just pressing buy. And while you're going to work or someone else is going to work and slaving for every dollar they make, people are sitting on their couch making money off of these simple little things that are happening around us that a lot of people don't ever think to even put any thought into. So this is why I'm talking about these things. Money works a whole lot better than your body does, I promise. It's a lot less stress. It's a lot less time consuming. I've met a guy, he made $1 million in an hour one day, just sitting on his laptop in between 9:30 and 10:30. And If that doesn't wake you up, I don't know what will. It's insane. I'm not trying to sell anything here. I'm just trying to open your mind at some of the things that are going on every single day. I don't want to sound like a salesman. I'm trying to sound more like a teacher. I hope I am. Let me know in the comment section below. So now that we've discussed volume and other indicators as well as asset inflation, I really want to get into what is going to happen next, like over the next few days. So for starters, tomorrow, which is the first Friday of the month, and every first Friday of the month, the Bureau of Labor Statistics issues this report. It's called the Non-Farm Payroll Report. It's also known as the Employment Situation Report, and like I said, it comes out the first Friday monthly. It's a huge indicator for the entire market, pretty much all markets, capital markets as well as foreign exchange markets. There's a lot of information that comes out about this all over the media, and there's a lot of information that's contained within it. But a lot of times it's overlooked because it's not really something you find out on the news. You might hear about like some of the unemployment statistics or something that kind of just get highlighted, but nobody even really thinks to look over this report unless you're into investing. But it's a major report, and it drives the economy for the coming weeks because it increases or decreases investor sentiment about which direction the market is anticipated to go. Some of those main statistics are going to be the unemployment rates, as well as the hours worked by Americans and the average amount of earnings that they made per hour that they worked. So this is pretty much going to lead into like whether the economy is expanding or contracting compared to other months in the previous month before the current month, letting you know whether the economy is doing better or worse, basically. And it has a direct impact on the economy because it kind of guides the way that investors think over the coming days to weeks until the next report is issued and a new opinion can be formed by investors. So after discussing the non-farm payroll report, I want to at least briefly talk about the election and what it can mean for the economy. So as we know, there's a lot of uncertainty going on right now with like voter turnouts. There's been a lot of crazy things reported about mail-in ballots and people sneaking them in, and whether you choose to believe it or not, it's definitely probably going to have an impact on what is happening with your invested money. And the news surrounding this election is also going to be a major impact on what's going on in the economy and in the financial markets as well. So basically, if we have an election that turns out with Trump on top, we're going to have a lot of people that are really excited because taxes will remain low. And that's a huge, huge thing for a lot of business. If you take a company like Amazon that makes a couple $100 billion a year, and you're talking about cutting their taxes 10%, just for simple numbers, we're going to say Amazon makes $100 billion, even though it's more than that. We're going to say they make $100 billion. If they get an extra 10% tax from a Biden victory, we're going to be looking at times 0.10. That means they're going to have to pay an extra $10 billion a year in taxes. $10 billion. And a lot of people are like, oh, it's Amazon. They're made of money, you know. Whether they make more or not, who really cares? But this is who cares. It's the employees who care. So this $10 billion could go to hiring $10 billion worth of new employees every single year. And I mean, if you're looking at each employee makes a $50,000 a year salary, just say roughly, they could employ over 200,000 more employees every single year. 200,000 employees could be added with $10 billion extra dollars. Or if they're taxed an extra 10%, $10 billion worth of employees could be cut away. Or in other words, 200,000 employees could lose their job from a company that employs over 1 million people. And this is big news because that's a lot of salaries that are being lost and a lot of money going down the drain for a lot of people that are relying on that income. So another thing we have to look at is, what does Biden want to do? Biden has a lot of great plans, don't get me wrong, but Biden is all about raising taxes. He said the first thing he wants to do is eliminate Trump's tax cuts, which goes back to increasing taxes by 10%, which Trump had in place, that we were going to be decreasing taxes, but Biden wants to reinstate those higher taxes to fund some of his programs. And to some people that sounds really great, but when you really think about it from an economics perspective and the jobs that you lose trying to fund these expensive programs and the money that's lost for businesses, first of all, there's less of an incentive for you to start a business. So that means there's fewer businesses in the industry that are all making more money, and they're almost becoming more monopolistic because those businesses are only able to survive because they can pay these higher taxes. Also, it becomes really expensive for the government budget, so they start dipping into your personal budget as well. A lot of these taxes fall back onto the employees and end up paying them in the long run. So for me, it's not that I'm just like some far right leaning Republican or some left hating Republican or even a Republican at all. I consider myself an independent, but what I do know is economics. And I do know that these programs sound great, and a lot of them will be great for a lot of people, but a lot of people, the majority of the people, are going to end up paying a higher price for the fewer people that are trying to reap some of these rewards from some of these expensive programs that are being put forth by Biden's policies. And it's not that that's a terrible thing. A lot of people might be really okay with paying for these extra programs for these less fortunate people, but what it does mean is that it's probably going to end up taking a draw in the stock market. However, right now, as the election's coming to a close and volatility is decreasing, we're seeing a lot of stock prices go up just because they're happy that this uncertainty is coming to an end. But that could mean that after a Biden tax system is priced into the economy, that the stock market then begins to fall. So now what we have on the board is something that a few of you might be really happy to see, and a few of you might be really unhappy to see. Donald J. Trump, he has a history of swinging the stock market. I mean, everything from coronavirus, press conferences, and just basically his entire presidency. He's had the power to come out and speak and say something that causes swings, and he's kind of been known for it. I'm almost wondering if he takes pride in establishing this market maker mentality as a president, and if he wants it to be chalked up to his legacy or something. But whatever the reason may be, he's always had this power over the stock market, and what he does in the coming days after the election is going to be very crucial to what actually happens in the stock market. He has some strong followers. You may be one, you may not be. Some of them are very radical. Some of them are just good supporters, but the radical ones could be inciting riots or starting violent rallies or protests or something, especially with all this news coming out about voter fraud and fake ballots and ridiculous voter turnouts. And then I think that combined with Biden's tax policy being priced into the economy and corporations paying more taxes, and if you pay less taxes, you're making less money. So if you're making less money and if you own a little portion of that company, that portion is going to be worth less because it's not going to be expected to be as profitable in the short term or even the long term. It depends. So basically, I was just wanting to make it very clear that there's going to be some uncertainty in the next few days surrounding what this man does and what he says, and if he tries to charge any lawsuits to any kind of states, and it postpones him being kicked out of office and someone else going in, or whether the Democrats try to charge some sort of lawsuits on voter fraud about Donald Trump remaining in office if that is the result. But that's the crazy thing. It's Thursday, and we've never waited this long for an election result, and it'll be very interesting to see where it goes. And I think it's definitely going to cause some sort of degree of uncertainty in the market, which could shift market sentiment and completely change the atmosphere of what we're dealing with. But that's why I want to put this video together today. I hope you liked it. I just wanted to kind of make sure that everyone understood the things that you don't just see on the news. The things outside of that, the things that is actually going on that we don't really get to hear about in the mainstream media, but the things that I think everyone should know about, because all of these things create major opportunities for profitability or major opportunities to be able to get into something at a great value. And that's what this channel is about. It's just about bringing value to you and bringing value to the world. Honestly, I just want everyone to understand these things because it really opened my eyes when I started understanding them, and it started a quest for me to keep learning more about the markets and keep learning more about the finance world and just how the entire world runs on money, but so many people really don't understand where it comes from or how it's generated or how to get more of it. So what I want to do is I just want to bring you the best content, and if you like it, drop a like, hit the thumbs up, add a comment, share it, let me know how it was. I'm down for all kinds of criticism, constructive criticism. Stay tuned because there's a lot more content coming your way.